One of the hallmarks of the cooperative business model is that the business is financed by the people who use its services. Additionally, because the cooperative is owned by user members, the profits or surplus of the business are shared with those owners. In a co-op, those profits are shared according to the members' use of the business or how much they patronize business. Because this topic can get complicated. After reviewing materials very and reading materials in the book also helps these individuals also professional when teaching about finances. As stated in previous presentations, the principles of cooperation impact the financial aspects of the business. Keep in mind that co-ops are organized to benefit members, not to maximize profits. That means that returns on investments, like preferred stock, are limited. That also means that the co-op should be financed by the people who use it. Because the people can't change over time, the financial co-op just change over time with the change it. As discussed in previous presentations, co-ops can raise capital to start or operate the business from direct investment, debt, or other sources. We thought previously about these sources for new co-ops, but existing co-ops can also use these mechanisms to capitalize ongoing operations or expansions. Operating co-ops can also use this chart from the United States Department of Agriculture publication Co-ops 101 is helpful for thinking about the sources of equity capital for a cooperative. We talked previously about direct investment in the form of stock or membership fees. In this presentation, we'll focus on equity capital that can come from ongoing operations through margins. Let's think about margins first for the case of a marketing cooperative. The cooperative purchases the products that their members produced, aggregates the products together, perhaps adds some value to the products, and then markets them to a wholesaler, processor, consumer, or another user. The co-op's goal is to cover the ability to use value and sell products. Having some additional labor above but an goal is generating other goods and expenses in order to realize margin. Those margins are then either invested back into the co-op or share members some use the business as a for dividend. You see on one side, the co-op gross income from selling products of $1,000. The good they sold cost users, and co-op products and sell goods of $1,000, so a net $1,000. Another method for a co-op to raise capital from ongoing operations is a per unit retain, which is a deduction from the proceeds of sales based on the value or quantity of products marketed for a patron. For instance, a co-op marketing livestock may deduct a set dollar amount per animal that they market through the co-op. Often, per unit co-op is an estimate capital or reserve for choice. Per unit retained co-op or distributed number. Per unit retains are unit costs. Unlike patronage refunds, per unit retains are not in the net earnings co-op. They are based on the volume of value of through the co-op. Let's take a look at patronage. Again, patronage refunds are based on the net margins of a co-op. Let's start with the definition of a patronage refund from the Internal Revenue Service. A patronage refund, or what is in this case called a patronage dividend, So now that we know what a patronage refund is and what a per unit retain is, let's review the ways that a co-op can share the refund or retains with patrons. The co-op can pay a patronage refund to members as cash or as additional equity investment in the co-op. When a written notice of a patronage refund or per unit retain is issued to a patron, it is either qualified or non-qualified. The amount of a qualified notice can be deducted by the co-op from its income. To qualify a patronage refund, the co-op must pay at least 20% of the patron's refund in money. This chart is helpful for understanding the ways that the net profits of a cooperative can be distributed and the tax implications of those distributions. Net profits can be used to pay dividends to preferred shareholders, in which case both the co-op and the shareholder pay income tax on the income. The profits can also be placed in a Here's an example of a patronage refund. Again, the co-op has gross income from the sale of goods of $100,000. This is business done with or for patrons. The co-op's cost of goods in this instance was $80,000. The co-op had a dividend.